Picture this: Amit, Reena, and Farhan run a cozy cafe as business partners. They've closed the books for the year when suddenly Amit says, "Wait, we forgot to credit interest on Reena's capital." Or imagine this: Farhan unknowingly received rupees 5,000 more profit than he should have. Now what?
Reopen the entire set of accounts? Not necessary. This is where the concept of past adjustments comes in. It allows us to correct such errors neatly, accurately, and without redoing the whole year's work. Smart, efficient, and essential for any well-run partnership.
So, what exactly are past adjustments? They're corrections made after the final accounts are closed when you realize a mistake was made. Maybe interest on capital was left out, or a partner got more salary than they should have, or maybe profits were split using the wrong ratio. Now here's the smart part: instead of reopening all the books, we simply pass one journal entry to fix it. Think of it as quietly setting the scales right without tipping over the entire accounting system. In a partnership, clarity and fairness are everything. But let's face it, even in the most well-managed firms, mistakes happen. Especially when multiple partners and complex agreements are involved. That's where past adjustments become so powerful. They're quick, efficient, and save hours of backtracking. Most importantly, they preserve trust. They ensure every partner gets exactly what they were promised, be it profit, interest, or salary. It's more than a bookkeeping fix. It's a way to keep the partnership strong, honest, and conflict-free. So how do we actually correct the mistake? We use a special account called the Profit and Loss Adjustment account. It's just like the regular profit and loss account, but with one mission: to fix what went wrong. Here's the process. First, identify and calculate the error. Then, pass a single adjusting journal entry. Finally, update each partner's capital account, debiting or crediting as needed. It's neat, quick, and most importantly, it restores fairness without complicating the books. Let's bring this to life with a quick example. Amit, Reena, and Farhan share profits in a 3:1 ratio. Now imagine this: Reena was supposed to receive rupees 4,000 as interest on capital, but it was missed. Farhan was overpaid 1,000 by mistake. Here's how we fix it: Reena gets 4,000 credited to her account, Farhan returns 1,000, the remaining 3,000 comes from Amit's share. The journal entry: debit Amit's and Farhan's capital accounts and credit Reena's. Just like that, error corrected, books balanced, and fairness restored. So, what does the actual journal entry look like? It's short but precise: partners' capital account debit. To partners' capital account, being adjustment for omitted interest, salary, or profit. The specific names and amounts will change depending on who owes and who's owed, but the format stays the same. A single line. A clear correction. No confusion. In business, mistakes happen, but what truly matters is how you handle them. Past adjustments show that you value accuracy, honor partnership agreements, and care about keeping things fair and transparent. Imagine missing an entry that affects a new partner's confidence, or worse, a retiring partner's final settlement. Handled right, these adjustments prevent disputes and protect relationships, both on paper and in practice. Let's wrap it up with the key takeaways. Past adjustments let you fix errors after final accounts are closed. They're handled through the profit and loss adjustment account. Partners' capital accounts are debited or credited based on the correction, and best of all, just one journal entry is all it takes. It's a smart, simple way to keep the accounts and the partnership fair and balanced. Up next, we'll show you how to apply this in practice step-by-step problem solving, complete with formats and numerical examples. Stay tuned and strengthen your command over partnership accounting like a pro.